All right, so we had another busy earnings week. We had some big companies release. I wanted to get into that. I wanted to get into this article too briefly. Bank of Canada seen holding at 5% as economy avoids hard landing. The U.S., they did raise a quarter point. Economists now see a soft landing for the Canadian economy with no recession this year despite interest rates at 22-year high. The economy will stall in the second half of 2023 but won't contract, according to a monthly Bloomberg survey of 27 economists. The median forecast sees the Bank of Canada holding its overnight rate at 5% into next year, and then they will start cutting in April. So again, does anyone know what's going to happen? Absolutely not. And has the Fed been wrong before? A lot. Has the Bank of Canada been wrong before? That happens a lot. So nobody knows what's going to happen for sure. But again, the longer we go on like this, the less likely we are to see a hard landing, right? And I mean, I've had plenty of people that were predicting a rate cuts as soon as the summer, and it's already midsummer and we haven't seen anything, and it's not going to happen anytime soon. So the chances of a severe recession is going down by the day, right? In my opinion, if we get to the end of the year without seeing anything major break, we're probably out of the woods. We definitely will see a contraction, though. I think that they're right to acknowledge that. But again, how deep is it going to be? Nobody knows. And another thing that people will assume, too, that if there's a contraction, it's going to mean the market's going to go way down. And that's not necessarily the case, right? I mean, for all we know, the market could go down 5%, right? We're going to see a pullback at some point. It's just a matter of when and how deep. But it's looking like it's not going to be anything too crazy. But again, nobody knows. So getting into the earnings over the past week, the first one, Microsoft. There's a handful of big companies, Microsoft being one of the bigger ones. Microsoft, stock was down, right? Stock was down. What were they down here? They actually, looks like they came down quite a bit, but then actually came back a little bit. They're only down about 2%, nothing significant. They beat earnings and revenue. And I think that this is kind of a story of the recent earnings releases, that you have a lot of stocks that are actually releasing solid numbers, but the stock has been down, right? And I think that that's simply because a lot of these stocks are a little bit over leveraged, for lack of a better way of putting it. I think they're trading a little higher than they should be. And a lot of the AI hype has not helped that either, especially with companies like Microsoft and Google and basically any big company. There's an AI twist to it, right? The next big one being Amazon. Amazon beat earnings, although again, if we look at the stock price here, the stock was actually up, right? So one of the few stocks that actually looks like they did good on earnings, although again, it was only up just over 1%. So nothing crazy there. Amazon, again, I think that they're probably one of the more underrated of the big tech. I think Microsoft is a great company, but they trade at too high of valuation. Apple, I think, is very good, right? They're very good. But the problem with all of these companies is that for them to double, it takes a crazy amount of growth compared to your average company, right? Your average company, whatever, $10 billion, $20 billion, $30 billion, whatever your average company in the S&P is, the amount of growth it takes for them to double is peanuts compared to what it takes for one of these companies to do it, right? So that's the one thing that has me a little bit skeptical. And not to mention, I think some of these companies are definitely a little overvalued at this point, right? Especially Microsoft. But again, nobody knows what's going to happen when it comes to short-term prices. But I think over the long term, they're going to trade basically with the market, right? And the reason being is that these companies have such a disproportionate percentage of the market that they're going to trade like the market no matter what, right? So again, getting into some smaller ones here, ARE, which is Alexandria Real Estate. Again, I do own a position in this company. They beat revenue and earnings. This is an area of real estate that I like. Again, they were actually up on the week kind of nicely, it looks like. That's nice to see. Operates, and develops and is focused on collaborative life science, agri-tech, and technology campuses in various cluster locations. So again, that's an area that I think is going to see a lot of growth over the next decade or two, which is why I own a company like this. And not to mention, too, you got about a 4% dividend. And if we look at that dividend, they're not growing it crazy well, but they are growing it consistently over time, right? 6% a year. Looks like they did have to cut it at one point, but again, they are consistently growing it over time. The next one is Domino's, again, another company that I own. This is actually one of the most underrated, this and microchip technology. I think these companies, are both in the top 10, if you go back like 25 years, performers in the S&P, but yet nobody really talks about them. Nobody really talks about them. And that's kind of crazy, especially considering you got a 1.2% dividend. They're growing 17% a year. I mean, why would anyone not be all over a company like this? If we look at the valuation here, let's look at the valuation, because that's the one thing that might be a little bit. Yeah, I mean, it's got a 33 price to free cash flow, although the 5-year average is 32. So it's probably about its fair value, maybe a tiny bit above. That's a little bit more than I'd like to pay. But again, this is a company that's always easily outperformed the market over the long run, right? I mean, they're really only a $14 billion company, right? So I still think they got a decent amount of room to grow, right? And again, over the week, they're actually up. They're up a little bit. That's nice to see. This is a really good company, a really underrated company. Let's just compare it to the S&P. Just over the 1 year, the S&P is actually beating it, but again, that's kind of irrelevant. 3 year, they're actually not. Over the 5 year, they're actually slightly less. But again, if we go back to 2000, again, Domino's is up 2,400%, as the S&P is up about 300, right? So I think it will outperform the market over the long run still, because I think there's still a lot of growth in this area, but it's not going to be to the same extent, right? It's not going to be to the same extent. But again, if they're growing their dividends 17% a year, that's really good to see as well. The next one is CN. This is another company I really like, Canadian National Railway. They missed earnings and revenue, and that was mainly due to, there's fires, there's a lot of issues going on, but again, I still really like this company. It's always done well. It's got what has it got for a dividend here? About 2%. They're going at 11% a year. A nice steady grower over time. You're not gonna crazily beat the market. Over the last 10 years, they haven't beat the market, but let's go back even further, because I'm pretty sure they have. Oh yeah, they've easily outperformed the S&P over the last 20 years. So that's why I like a company like this. And not to mention too, there's never going to be another railroad built in Canada, a railroad company that competes with CN or CP in Canada. So again, they have a duopoly. We have an ever-growing population, right? So over time, the demand to transport goods, I don't see any way, a snowball's chance in hell that demand isn't going to go up over time. Now, again, we may come up with alternative ways of moving it. That's an argument you could make, but no way in hell that we're not going to see an increase in demand for transporting goods and services. So that's why I like this company. The next one is Visa. Again, Visa is an absolutely amazing company. They are borderline if they're expensive right now. What is their exact valuation right now, just out of curiosity? Actually, they're below their 5-year average by a decent amount. 26.4, 5-year average 32. So they're still pretty clearly below their 5-year average in the valuation. And these are some of the most profitable companies you can possibly imagine, because there's very little overhead, right? So that's why I love a company like this, is that they're just printing money, right? They're so profitable, it's not even funny. And again, not to mention too, you got a very low dividend. What is it, like 0.7, 0.8%? Yeah, 0.676. But they're growing at 16% a year, and that's on a payout ratio of 23%. So they're going to keep growing this dividend 16% a year probably, right? They're buying back shares. In my opinion, Visa is close to a perfect company as you can possibly imagine, right? The next one is going to be ALGN. This is a company I really, really like, although they're just too expensive. I've been wanting to get into it for over a year probably. If we look at their price of free cash flow of 62. So again, it's a healthcare company. They provide medical devices and stuff like that, which is a very good area to get into. But again, they're just too expensive. They beat earnings and revenue. So let's look where the stock ended up on the week. Stock was actually up very nicely, very nicely. Just out of curiosity, what is that? That's a crazy amount here. Let's take a look and see. It's up about almost 14%. So that's very, very good. And again, this is a $29 billion company, right? So crazy for 1 week. The next one here is AT&T. This is a company that a lot of people are interested in because of their dividend. Although again, they missed on revenue, but they beat earnings. So this company just consistently grinded lower over time. I mean, over the 1 week, the 1 month, the year to date, the 1 year, the 3 year, the 5 year, you name it, the company is down. And that's the big problem with a company like this is that, yeah, they have a 7.6% dividend, but it feels like you're trying to catch a falling knife investing in a company like this. So that's why I steer clear. And again, this is a point that I've made several times before, is that the dividend yield on a company is completely irrelevant, because if the share price, I mean, if you got a 7% dividend, but the company's going down 5% a year, well, you actually have a 2% return, right? So that's an important thing for people to understand. But you also need to keep in mind too that, again, your overall return is what you're concerned about. So a lot of people, they buy these companies thinking they're getting this 7% return per year, but they're not, because the share price is going down. People say, oh, I'm buying it for income, but it's like, okay, well, you're still losing principal. So you really want to stay away from companies like this, in my opinion. Now, eventually it probably will find a bottom. It probably will, but no one knows that for sure, right? No one knows when that's going to be. The next one is Chipotle. This is a company that's growing very nicely. I've wanted to get into, but I think they're pretty expensive as well. Let's see what their valuations are here. Price to free cash flow of 53. Yeah, so that's just too expensive, right? I mean, if they were a tech company that's growing like insanely quickly, maybe I would do it. But that's too rich for me for the sector that they're in. They beat earnings, but they missed revenue. Let's see where they traded on the week. I believe they were actually down, but let's double check. Yeah, they were down actually a lot, right? Let's see how much they were down here. 7.8%. So yeah, that's pretty significant there. But again, that might provide a buying opportunity. But again, they're still too expensive, right? They're still too expensive. I'd want to get them cheaper, but I don't know if that ever will happen. But again, that's okay. The next one I wanted to get into is Coca-Cola. I probably should have talked about this one sooner, but that doesn't matter. They beat earnings and revenue. Coca-Cola, another company that I've wanted to get into literally for like 2 years. But again, they're just too expensive. And if we get into that, price to free cash flow of 30, the 5-year average is 28. So you could argue they're fair value, but I still would like to get them cheaper. I'd like to pick them up in like the mid 50s, which I've had a price alert on for the longest time, but they've never hit it, right? They've never hit it. If we go year to dates, they're basically flat. I mean, they started out at 62.9, they're at 62.4. If we go back 1 year, they're actually down a little bit. We go back 3 years. 3 years are actually up fairly nicely, but 5 years, again, they're up somewhat okay. The main reason you're buying a company like this probably is for the dividend, right? They're not going to see crazy growth. You got a 3% dividend. They're growing at 3% a year. Again, you're going to see that consistent slow growth over time, but you're not going to get crazy returns. And that's another reason why I haven't been too eager to get into this company. The next one is ODFL, Old Dominion Freight Line. They missed revenue, beat earnings. Stock was down. Actually, they were down, I believe, initially, but then they actually turned it around and hit a new all-time high. So this is a company that I have a small position in. I've been trying to get a larger position in, but they're just too expensive right now, and it kind of bothers me because I was thinking of picking more up at like 330, 340, and I didn't do it. Now they're at 427, right? So that would have been a nice little return, but I think we'll see a pullback at some point, and then I'll probably jump back in there. Again, price to free cash flow of 58. Again, just too expensive to get in it at the moment. But again, if we look, again, the 5-year returns of this company. Yeah, so this is definitely one of my favorite companies, probably my top 5 to 10. I've talked about it a lot before. Again, you only have a 0.37% dividend, but they're growing at 35% a year, which is just utterly crazy. Is that maintainable over the long run? Absolutely not. It's not going to happen, but even if they can grow at half that rate at the next 5 or 10 years, I would be happy with that. So the next one to get into here is Vici Properties. Again, this is another company I do have a position in. They own a lot of casinos and stuff in Vegas. I believe they have some other kinds of properties as well. They beat earnings and revenue. This is a company, you're buying it mainly for the dividend. Again, it is a REIT. Again, just under 5%, but they're growing that dividend very nicely, 19% a year over the last 5 years, which is very nice. Are they going to do that over the next 5 years? Probably not. But again, you don't really need them to, right? Even if they can grow at 10% a year with a 5% dividend, you're already killing it, right? And not to mention, too, this is a company that has had solid share price growth over the long run, at least. I mean, they're up pretty nicely over the 3-year, over the 5-year. They've almost doubled. So that's exactly what I want to see out of a REIT. This is definitely one of my favorite REITs, probably in my top 3 or 4 REITs, which is why I like talking about it. The next one is AB. This is a company I do have a small position in. Again, mainly for the dividend. The dividend is, I think, about 8%. Yeah, 8.11. This company is actually down on the year by a decent amount. But, again, that's mainly due to the economic realities, right? Earnings down, revenue up. But not only do they have an 8% dividend, they're actually growing it still. Actually, over the 5-year, they're not. But again, this is actually pretty all over the place. But again, over time, it has gone up. It's just down from the high it was in 21 and 22. So this is a company that's going to follow the markets. And honestly, I may cut this position out. Again, I bought it mainly for the dividend, which has been actually fairly consistent, even though it hasn't been perfectly consistent. It has been fairly consistent, but that is the reason that I bought it. The next one is DLR. This is a digital realty. Again, another company this is a company that a lot of people like, although I'm not a huge fan of. I think that EQIX is better. 4% dividend. They are growing it a little bit, but again, nothing crazy. Its revenue and earnings were both way up, but again, I think that there's better alternatives in the field. The next two to leave it off here, Chevron and ExxonMobil both released. Both of those didn't have the greatest numbers, but that's solely due to the price of oil, right? That's solely due to the price of oil. If I were to pick one or the other, it probably would be Chevron. Let's just compare them generally here. The numbers are actually fairly consistent, but again, Chevron has a little bit higher dividend, and they are growing it a little bit quicker, right? 3.5 for ExxonMobil with a 2% growth rate. Let's check Chevron. I'm pretty sure they're higher on both of those. Yes, they are. So that's honestly why I would pick Chevron. I think they're both very, very similar companies. And again, I'd pick Chevron because you get a higher dividend and it's growing quicker, right? And again, oil and gas companies, that's one of the main reasons you're buying them, is because you want them to pay out that cash flow. And again, you do want them to grow over time, but you want them to return as much of that money to shareholders as you possibly can, right? Just in my opinion, at least. So anyway, that's what I wanted to talk about today. That's earnings from last week. Again, the last few weeks have been pretty busy. So again, it's always nice to talk about. If you liked the video, please comment, like, subscribe, all that good stuff, and stay tuned for more.